One of the best ways to invest through market uncertainty, concerns about inflation, concerns about rising interest rates, still generate some return and give yourself a little bit of a mental edge is with dividend stocks. Stocks that pay you is a great way to be able to hold through volatility and also over the long term generate results that can outperform the market. I'm Jason Hall. This is Investing Unscripted. I'm going to talk about 3 dividend stocks that I've bought very recently, some within the past few days, several of them more than once so far this year. We're going to talk about those 3 stocks, why I bought them, why I think they're great investments. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should check out our special link. It's in the screen right now. You see it's fool.com/unscripted. Go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. This video can be worth 13 great stock ideas to you. Be sure to check out our special link. Again, it's fool.com/unscripted. Okay, let's get to it. Here is a look at those 3 dividend stocks that I've been buying recently. We got 2 REITs, 2 real estate investment trusts with Realty Income, EPR Properties, and Truist Financial, which is one of the largest banks in the US, has a big presence in the Southeast. So as you see on the screen, all 3 of these stocks pay really good dividend yields. You're looking at Truist Financial, the lowest yield at 5.6%, over 8% for EPR Properties. Realty Income's dividend is 5.8%. Now, one of the reasons that I bought all 3 of these, and you see it right there on the screen with the dotted line, all 3 of them are paying a dividend yield that is a pretty good bit above the long-term average. So that's a starting point for why I bought these stocks, because you can get really attractive dividend yields right now. Now, one question you might have is, if they're paying a higher yield right now, isn't that kind of a sign of trouble? And in many cases, yes. When the yield has gone up, that means there's some sort of a risk that the market sees. But I do want to point out that broadly, we look at banks, we look at real estate related stocks, and their yields are generally all up right now. A couple reasons that's happening. Investors have concerns about that heavy debt that real estate companies have. So the prices have come down for a lot of those stocks. That's pushed up the dividend yields, right? Now, with banks, rising interest rates have also created some pressures and concerns because they're having to pay more to depositors. There's more pressure on the cost side of their business. It's made it challenging to make it up on the higher yields they can charge on loans on the other side. So there's pressures on both of these businesses. The big reason that yields have moved up and has affected prices down is because guess what? You can get 4% in a money market now. You can get ultra high safe yields in treasuries that the federal government's going to give you your money back when that bond matures. It's a safe 100% guaranteed income. When you have that, what they call zero risk rate of return, that yield is high. Guess what? Stocks have to pay a high yield too to compensate for the risk of owning the business and the volatility of owning those assets. So that's part of the reason why the dividend yields have gone up as well. Now, why these 3 in particular? We're going to start looking at their charts and the price performance of these stocks going all the way back to 2010. Let's start with Truist Financial. The reason I wanted to start with Truist is because it's the one of these 3 that, going back to the post-financial crisis period, really hasn't been a great investment for any particular period of time. On the screen, the orange, yellow, that's the S&P 500's total returns. And then the purple is Truist's total returns since the beginning of 2010. And really, it never was a market beater for any of that period of time. Now, of course, we have the steep drop in 2020. That's the pandemic happened that sent basically every stock down. And like every other stock, it skyrocketed after that. And then, of course, since 2022, we've seen interest rates skyrocket. That's pushed bank stocks down a lot. Early 2023, right here, we had the FDIC take over 3 major U.S. banks. There's been that banking crisis that happened that kind of rattled investors. As a result, Truist stock is down a pretty good amount. Why am I interested in it right now? So, frankly, I see a tremendous amount of value here. The market has certainly bid it down. If you think about some good ways to value banks, you think about price to book value and price to earnings. So here we are again with the chart. So this is a situation where I really am value hunting here. Number one, I'm starting with a good quality business. Maybe not the greatest stock performance, but Truist Financial is very well run. It's a combination of 2 strong legacy regional banks in the Southeast that have generally delivered really solid financial results over the long term. And you look at the valuation and there's just way too much to like. Price to book value for Truist Financial trades for about 95% of book value. In other words, if you bought the whole thing, the underlying assets based on book value is worth 5% more than you would be paying. Now, there's some reality here. Banks don't have to mark all of their assets to market value. And we do know a lot of loans that it issued in 2020 and 2021 at those ultra low interest rates and that zero interest rate environment are worth less. If the bank had to liquidate those assets, it would get a lot less for them than maybe it's carrying value. But in general, I think it's still undervaluing the earnings power of the business. So we look at the price to earnings ratio again, about 9.3 times trailing earnings. Now, its forward earnings is going to be a little bit higher than that because most banks are not going to earn as much in 2024 as they did in 2023. But again, we look at the long-term average, and typically you're going to see 14 to 15 times earnings is really a far more reasonable valuation for a bank like Truist Financial. It's not going to grow at a super high rate. It can grow at a mid-single digit rate and grow revenues from cash flows and from interest payments that it earns and from fees that it earns, its banking fees. If it's going to grow those in those mid-single digit rates over the long term, that's pretty good because that should result in high single digit earnings growth. You take that mid to high single digits earnings growth and you match that up with a dividend yield that's about 5% at recent prices, all of a sudden your potential for long-term returns looks a lot better. That dividend yield of 5%, you might think about it compared to a lot of other banks and say, sounds to me like the dividend might be at risk of getting cut. Let's go to the tape. Let's look at some numbers on that. So this is where it's really important to have a good understanding of bank earnings, non-cash impacts, and to be able to parse the data a little bit. So you see, needless to say, negative a $1.1 billion net loss in 2024. That sure makes it look like the $3 billion in dividends that it paid last year is being super unsustainable. But this is where you have to remember a lot of that loss was due to some write-downs that it took that are not going to affect its actual cash earnings. So that's really important. So again, if we benchmark it back to around that $5 to $6 billion in net income that it was generating prior to the large write-downs it took in the last quarter, all of a sudden that $3 billion in dividends that it paid is a lot more protected by its true earnings power. I'm also a big fan when it comes to banks of buying them when the market does give you an opportunity. We showed that long-term chart where Truist hasn't really ever been a big long-term winner, but it also hasn't traded for 95% of book value and less than 10 times earnings in over the long term either. So I think it's a really good starting point to create some value, put in that dividend, that high yield, and you've got a pretty good case of earning, if not a market beating result, 5% dividend yield and a safe dividend. That's a really good floor for returns that if you can just get a little bit of growth on top of that, a little bit of earnings per share growth on top of that, things get really, really attractive really quickly. All right, let's move on to our two REITs. I'm going to start with EPR Properties first. So EPR is a real estate investment trust that owns experiential properties, things from movie theaters to ski resorts, experiential lodging, lots of things like that. That, of course, I led off with the one movie theaters that's certainly created some risk. But if we look at that blue line on the chart here, that blue purple line, you can see really for about a decade, this was a market beating stock. And then, of course, the pandemic happened. And when you own experiential real estate and then a global pandemic happens, all of your tenants, they have to shut down their business. People weren't going to movie theaters. A lot of other in-person experiential businesses had to close their doors for a period of time. And it's taken it a long time. It took a long time for a lot of those businesses to recover. EPR also had to slash its dividend. Of the three stocks we're talking about, this is the only one that had to cut its payout during that period, had to preserve cash, give its tenants some time to come back. And needless to say, stock is still, it's up a pretty good amount. It's up 200% roughly in total returns from the bottom of the pandemic, but it went from a steady market beater to a massive, massive laggard. Now, of course, mention movie theaters again, we're going to bring it up. That's the elephant in the room when it comes to EPR Properties. Almost 40% of its base rents come from its movie theater tenants. And the movie theater industry has had a brutal period. It was already in decline before the pandemic. And a lot of people had it in their heads that the pandemic was just going to kill the movie theater industry. It did bankrupt one pretty large player with Regal Cinemas that did go through bankruptcy and reemerged. Guess what? EPR is one of its major landlords, and EPR was largely unaffected by that bankruptcy, and its rents were largely unscathed. I say that because it's really important to point out EPR we have a path forward with concerns about AMC, for example, is one of its largest tenants. Even if we do see a bankruptcy situation for an AMC, well, guess what? EPR owns most of its best theaters. Those theaters are going to keep operating. And just because a company goes into bankruptcy doesn't mean it just stops paying everybody. Still going to be paying rents. There might be a period of time where those rents maybe get negotiated, but it does seem like EPR's business is relatively well protected. Now, we've also seen it decrease its exposure to movie theaters. At one point, over a couple years ago, it was well over 40% of its base rents were from movie theaters. That's down to 39% as of the end of the last quarter. So we're seeing good progress. We've also seen it reset its dividend. Again, we cut the dividend back during the pandemic. It's returned to dividend growth as its business recovers, as the movie theater business recovers, and as it looks for other channels to grow its business. This is a bit of a risk reward play. There is some risk there still. I think it's largely overstated. And I'm taking advantage of this opportunity with the expectations that that 8% dividend yield is probably safer than the market thinks it is. Even if something happens with that dividend, maybe they can't grow the payout as much going forward. Even if they do have to lower the payout, I feel like I have some margin of safety in the valuation. And as a long-term focused investor, I'm less concerned about some volatility risk in the short term. One more REIT to talk about here, and I'm saving my favorite for last, and this is Realty Income. So again, that same starting period of 2010, we see this was another just absolute trouncing the market until the pandemic happened. And even after the pandemic drop, the stock kind of chased the market higher as the economy came back. EPR's tenants, largely standalone real estate. These are mostly, it's what they call net lease real estate. So they have these standalone businesses that are, a lot of them are e-commerce resistant. They're pretty resilient in terms of economic ups and downs. But the tenants are responsible for the rent they pay to Realty Income, but they also pay to maintain the properties, insurance, taxes, all of those other things they're responsible for as well. Now, more recently, you see the stock prices come down and stayed down even when the market started to recover. It's all about interest rates here. This is a situation where lots of debt. You take a lot of debt when you're a REIT. You use that debt to fund a lot of your property acquisitions. Interest rates going up means your cost of capital is going up, and it means your interest expense is going to go up as you refinance debt over the long term. I don't think that means that Realty Income's business is in trouble. To the contrary, these guys are really good at allocating capital. Their Spirit Realty acquisition they made late last year that closed early in 2024 increased their market share. There's a tremendous amount of opportunity to continue to consolidate, not just in North America, but also in Europe as they've taken some expansion there. They've started nibbling around the edges in other property types, but they're being smart the way that they're going about it. They made a $900 million investment in the real estate. So now they have the Bellagio as one of their largest tenants. So they've started to take some moves into Las Vegas, where there's a tremendous amount of opportunity in experiential real estate. They've begun to take some interest in data centers, smartly partnering with one of the leaders there with Digital Realty Trust. So you go in with a good operator, you allocate capital well, and there's opportunity to make money. You put all those things together, and I look at Realty Income as one of the long-term winners. You go back to 1994, this stock has absolutely trounced the market. They've grown their dividend basically every quarter since they started a payout. That's a remarkable stretch of dividend growth. Dividends well protected by their cash flows. I think the market's concerned about interest rates has created an opportunity for investors to buy this long-term stalwart at a really, really attractive price.